What's up everyone, my name's Robbie, this is Robbie in Manila, and oh man, we have an awesome video. Today's video is really going to focus on the highest yielding ETFs. And now here's the thing, a lot of people look at ETFs, or they look at index funds, or they look at mutual funds, and all they look at is the rate of return and what funds have had the best return. But at the end of the day, that's not how you should be doing this. What you should be doing is finding ETFs that have the best returns and the best, let's say, yield if you're looking for yield, but also have the lowest amount of risk that they take. And I saw this when I was a financial advisor. Tons of people just look at the return of a fund, and that's the only thing they do when they go to pick the fund. So in today's video, we're gonna balance those two really important things. I'm gonna show you my favorite 3 ETFs in terms of yield, but that also have really great risk-adjusted returns. And now I know you're ready to get into this, so let's roll the intro and let's get started. Okay, everyone, let's go ahead and get started. But first, everyone's always telling me, Robbie, you know that the best way to get yield is really by hitting the like button. So, that's what they say, so why don't you hit the like button? Okay, everyone, welcome to the 3 best dividend ETFs with 3% plus yield. So the deal is, I did a ton of research for this. You would think it's easy to find ETFs that are yielding more than 3%, and it is, there are quite a few of them, but a lot of them are really not good ETFs. They invest in very specific things that I wouldn't really recommend people putting their money into. So, I put a ton of work into this. I found a few, I thought they were good, turned out, they just didn't meet the criteria on risk, and I finally came up with 3 that I really do think are pretty great yielding ETFs. They all yield over 3% like it says, and we're going to go through this now, and just remember that it's very important to get a good amount of yield with the proper amount of risk, okay? So that's really what we're trying to achieve here. So let's start, and we'll go with first the Global X NASDAQ 100 Covered Call ETF, ticker symbol QYLD. So I'm going in order of my favorites here. So this is my 3rd favorite. This is a really, really great ETF because it yields it's got a crazy yield, okay? So let's just go over the strategy of this ETF. So basically, it is a covered call strategy. It seeks to provide investment results that correspond generally to the price and yield performance before fees and expenses of the CBOE NASDAQ 100 Buy Right V2 index. Now, what does that mean? So essentially what this is doing is it's basically investing in companies that are inside the NASDAQ, the NASDAQ 100. So what I believe it might be the top 100 largest NASDAQ companies based on market capitalization. I could be wrong, but I believe that's what it is. But then it buys these stocks, and it also writes covered calls because it owns the stock, so it's writing calls to generate income. If you don't know what that means, don't worry. I mean, it's not a big deal. But basically, in an options contract, if I hold a Apple, for example, I could write a call, or I could sell a call, and generate income. And someone would purchase my call option, and then if the stock were to go up, that person would actually call my stock, my Apple stock, and they would take it. So then I have to go buy Apple stock again if I want to keep the stock. So essentially, that's what's happening, but honestly, you don't need to know because, just generally know what it is, but you don't need to know what call options are and stuff like that. Just know that this fund is using the strategy to make money for you. And it's also, of course, investing in the stocks, so the stocks also have yield. They pay dividends, right? So you're getting all this great stuff. And by the way, if you don't know the difference yet between ETFs and index funds and mutual funds, I'll link a video right here so you can take a look. Also, I'll just put it in the description. Take a look at that if you're still a little confused on this whole thing. But so the deal is with QYLD, we have an expense ratio of 0.60%. Hold on, I feel like this is it's not really bright enough. Let me make this brighter, okay. So the expense ratio is 0.60. This is the highest expense ratio out of all of the ETFs we're gonna go over. Now, is it justifiable? I think that this is a really good fund, and I think it is justifiable because of what it gives you, which is this yield, this distribution of 11.16%. Now, you're probably thinking to yourself, like, you have to take crazy risk to get this. Well, you really don't. Actually, this has less risk than the other ones, the other ETFs I'm going to go over, which is crazy. But the thing is, I think a lot of people think when you get 11.16% yield, then you are going to have like a ton more performance than like the S&P 500 and the broad market. That's not how this works. You're getting a lot of yield, but your total return may not be that amazing, but you're getting this yield. So who is this for? This is really for someone who is, let's say, if someone's younger and they're trying to get to financial independence, retire early type thing, if they're in the FIRE movement, this could be a great fund for someone who's like in their 45 years old, 50 years old. So if you want to invest in something like this, this could give you good yield and it could be a part of your portfolio. By the way, made a video about why it's so hard to retire before the age of 40. Link it right here, just if you want to take a look at that. I'll also link it in the description. There you go, link it in the description. So, okay, we're gonna see the total return in a second. I don't want to go overboard on this. I hate when my videos are more than 20 minutes. I'm gonna try so hard to make this thing not that long. Okay, the growth of the growth of $10,000 in 5 years grows to $16,242. Now, if you looked at the S&P 500 over this period of time, it grows to a little over $20,000. So this definitely does not grow as high as the S&P 500 does, okay? And it's 5-year category rank, so the category is, QYLD is in a category of ETFs. It's in the top 1% of its category. So it's a very good ETF. These are the top 10 holdings. It's a NASDAQ ETF, right? So it's got Apple, Microsoft, Amazon, Tesla, Facebook, all these things. You might be thinking to yourself, well, why is Tesla in there? Tesla doesn't pay a dividend. Like, how is this generating dividend income? Well, on Tesla, it's not. They're selling covered calls on Tesla and generating income from that. So, that's the deal, right? So it's got a strategy. It's not just investing in dividend stocks and taking the dividends. It's doing this other thing as well to get high yield. Next up, we have the returns. So this is an interesting chart to always look at. So this shows the QYLD is the blue line here, and it's against the S&P 500, which is this kind of like yellow looking line. And so it's underperformed the S&P 500. So, this is not a fund to buy just because you want to try to like make tons of money. You want yield. So I should have kept going on the thing before, but okay, if you're trying to retire early, this could be great. If you're retired already, this could be great. If you're looking to retire soon, this could be a great thing to add to your portfolio, right? And then when it comes to these things, you could add 10% of your portfolio into one of these ETFs. Some of these you could go a little higher. Of course, probably good to diversify your ETFs even, not to just invest in one. So let's keep going here, and then we're going to go through this stuff in a second. This is just QYLD returns. Again, you're going to see the 5-year return, 15.22% versus it was the S&P 500. QYLD's market price was 9.98, but this does not include dividend reinvestment. The other chart I showed did include dividend reinvestment. This is just price return. Okay, so here we have the risk, and this is really the most important part of this presentation, if you will. So I'm going to take a little bit more time on this part just so you understand how this part works. Once you do, I think you're going to start understanding more about how to like really figure out if an ETF is the right ETF or not. Works for index funds too, mutual funds, whatever. So first off, QYLD is a 5-star fund according to Morningstar. That's the highest rating they have. That's great, right? So they really think it's a good fund. The risk versus the category is above average, so there's a little bit more risk than the other ETFs that are inside this category of ETFs, which are like high-yielding ETFs and I'm not sure exactly which ETFs are in the same category as QYLD. It might be covered call style ETFs. It depends how Morningstar categorizes them. Returns versus the category are above average. So if you have above average risk, you want to have above average returns, okay? What you wouldn't want to have is like high risk and then low returns, right? So that's a bad way of looking at it. So these are things we're trying to figure out. I put this here. We're not going to go in depth into this, but alpha is like your return. So it's got a better alpha than the category. Your beta is how much of a return you have versus the S&P 500, or rather the volatility of it. So it's 0.72, so it's less volatile than the S&P 500. The S&P 500, if it's a 1, it's basically moving with the S&P 500, right? S&P 500 goes up 10%. If this also went up 10%, it's matching the S&P 500. Let's just, as an example, the S&P 500 goes up 10%. This goes up 4% or 5% or 6%. It goes up less. But then the downside, it's also going down less. And that's what we're trying to figure out, right? So this is the beta is not bad, so it's not a very risky and volatile fund, and the standard deviation is really important. It's got a pretty low standard deviation, which is also like the range of prices. So this is good so far. So in terms of risk, this is pretty good. Now this is very, very important. Now you can always find this by typing in the ticker symbol in Google. Go to Google, type in the ticker symbol, type in Morningstar Risk. You'll go right to this page and you'll see this stuff. This is important. So market volatility measures. Okay, so what is this? A capture ratio is, for example, if the S&P 500 is the market and it's got a 100, its upside is 100. If it's got a upside capture ratio of more than 100, it's getting more of the return than the S&P 500 does during up times. And then on downside, you want to see if it's got more or less than the S&P 500 on the downside, and you want it to be less than 100, so that it's less than the S&P 500, at least for this fund. Usually you do. If you could find something that has better upside, or good upside but not as much downside, that's a great thing, okay? And so these are all things we're trying to factor in and figure out. So here, the category actually is less volatile than this fund. It had a 49. So the upside is not as much as this fund, but then on the downside for this fund is a little bit more than the category. But of course, the index, or let's say the market, has more risk on the downside, but it has more upside potential as well. Okay. And then the maximum drawdown over a 3-year time period is negative 16.64%. The category, it's a little bit more than the category, but the index, it's less than the index. So again, you have great yield on this fund. You have it has a lower drawdown in its worst time period in 3 years. This is the drawdown peak to valley. Most of the times you're going to see at this point that it's during the pandemic, but so that's what you're trying to find out. So this next part here is the 5-year. So again, it's very close on this one. So 71, 71, so 74 on the downside. So it's good. So doesn't have that much downside. Upside's not quite as much as the market. You're getting a 10% yield. There you go. So this is going to be a great yielding ETF, tons of yield, but your total return probably won't be as much as if you just went with one of these other ones that I'm going to show you next. Okay, so our number 2 ETF is Invesco Dow Jones Industrial Average Dividend ETF. DJD is the ticker symbol. And let's figure out what's up with this fund, or this ETF rather. So DJD is a Invesco Dow Jones Industrial Average ETF. It's based on the Dow Jones Industrial Average Yield Weighted Index. The fund will invest at least 90% of its assets in common stock that comprise the index. You can keep reading this. Essentially what it's doing is it's finding the best yielding dividend stocks inside the Dow Jones. It's equally weighting it, I believe. If you don't know what that is, don't worry about it, because the Dow Jones Industrial Average is price weighted. And actually, if you want to see my video on the Dow Jones Industrial Average and why Tesla won't be added to that anytime soon, I'll throw that right here. I do talk a little bit about the weighted average of the Dow if you're interested, okay? So anyway, let's go on here. It invests in the Dow stocks and it ranks them on yield. So expense ratio, 0.07, very low expense ratio. This is great. The other expense ratio is a lot higher, right? QYLD. The 5-year category rank, 11%. It's in the top 11% of all funds. That's good. Growth of $10,000 in 5 years grows to $17,587. So it grows to a higher amount than QYLD, which was in the 16,000 area. But the distribution yield is lower than QYLD at 3.47%. So you get less yield, you get more total return if you were to reinvest inside the fund. So, and this is like what we're trying to figure out. So you get yield, there's total return. We have to balance this whole thing out with risk. So what does DJD invest in? We got Chevron, Dow, Walgreens, IBM, JP Morgan Chase. So these are the weightings of the portfolio. As you might know, the portfolio weightings, or the Dow's weightings, for example, United Healthcare is the largest weighted company in the Dow. So here we have Chevron is the largest weighted company in this ETF. So it's really not investing just in the Dow the way the Dow has its weightings. It's really finding ways to invest in the higher yielding Dow stocks. So moving on, DJD returns, again, this is 17,587 versus the S&P 500, 20,304. So again, it's not performing on a total return basis. This is showing if dividends are reinvested. So it's not going to outperform the S&P 500. This is not something you would own to try to outperform the S&P 500. It's something you'd own for some yield. And then, well, I shouldn't say that. There are times where yield is going to probably give you better returns than the S&P 500. We just are really not in that time period right now. We're in like a very high growth stock type time period. So, it will come back. It will come back, but I don't know when, So, but anyway, you can get great yield with this and take less risk than the S&P 500. So, again, very important part, right? DJD, it's a 5-star ETF, great, ranked by Morningstar. Risk versus the category, below average risk with above average return. That is exactly what you want, like I said before. So lower risk, better return, love it. The alpha is a little bit less than the category, of course. Actually, the index, it's better than the index. The beta is less than both. Remember, beta's volatility, let's say how risky the fund is. Standard deviation, let's say the range of prices is also lower. So great. So not a very risky fund comparatively. And then we look at the capture ratios and we see upside, it's getting 82% of the upside, where the category is getting 85%. So it's getting a little less upside over the past 3 years than the category. On the downside, it's getting less of the downside by a lot than the category, 102 to 114. Great. Then we have the 5-year. So the 5-year, 89 on the upside versus 87. So over the 5 years, it's got more of the upside. On the downside, it's actually also got a lot less on the downside. So great. So the maximum drawdown is negative 23.79% versus the indexes, which is more, 26.73, and the category, 26% also. So the drawdown's not quite as much. Now, this is, of course, a lot of these funds these days have the largest drawdowns around the time the pandemic hit. It's just the way that the market went. You look at any chart, a lot of the downside is around this time, right? So that's how much the drawdown is. So it's more than QYLD, but it's not too bad. And now we have our next ETF, which is my favorite ETF, and it is Charles Schwab, or the Schwab U.S. Dividend Equity ETF. SCHD is a ticker symbol, and it's my #1 ETF for yield. Let me show you about this pretty amazing fund. So, or ETF rather, Exchange Traded Fund. Okay, the F stands for fund. So, the objective of this is the fund's goal is to track as closely as possible before fees and expenses the total return, the Dow Jones U.S. Dividend 100 Index. Okay. So that's what it does. These are some highlights, tax efficiency and stuff like that. SCHD, this one actually has the lowest expense ratio of all of them. It's got 0.06, so very low expense ratio. It's in the 5-year category rank in terms of return is 3%. So in the top 3% returns, great. The growth of 10,000, this one is 19,463. So the other two funds, the other two ETFs, QYLD was in the 16,000 area. DJD was in the 17,000 area. This is in the 19,000 area, right? So it's doing better on its total return. The distribution yield is 3.16, so it's got the lowest yield of these, but it's got the highest total return. SCHD top 10 holdings. We got ExxonMobil, like we saw before in DJD. You got Texas Instruments. IBM was also in DJD. We got Pepsi, BlackRock, 3M. Okay, so like nice big companies. You've heard these companies, you know them. The returns for SCHD again. Here we see SCHD 19,463. This is showing the DJ US Dividend 100 trailing index, which is what it said that it's trying to track. So that's that's comparing it here, not the S&P 500. Remember, the S&P 500 returned during this time period of 5 years about 20,400 or something like that. So anyway, it's outperforming its category, large value. Worst 3 months, best 3 coming up in a sec. Again, we'll look at that in the risk part. These are the returns. Take a quick look. Actually, I'm not going to go over these. You can just pause it if you want to. Remember, though, these are price returns. These do not have reinvested dividends. Next up, SCHD risk. Okay, the very important part. So we got SCHD, a 5-star Morningstar fund. Risk, below average risk, and high return versus the category. Love it, right? Great stuff, okay? So alpha, negative 2.03 versus the category. Way better, and way better than the index. Beta, way better, well, a little bit better. Volatility than the category, a little bit better than the index. Standard deviation, the same thing, less range and price movement than the category and the index. Great stuff, great stuff. So SCHD capture ratios, let's take a look at this one. Very important, again, you know that. So fund, 91 on the upside versus the category, only 85, so doing way better than the category. On the downside, only 98 versus the category 114. This is very good, very good. Schwab is doing a really good job with this fund on the 3-year and on the 5-year. Upside, 93 versus the category 87, so better on the upside. Downside, 893 versus the category 111, better on the downside. So good stuff. And then finally, the maximum drawdown, 21.55% versus the category 26 point something. Great, right? So this is a very good fund. I love it. I think it's great. I think these are all very good ETFs for anyone who's looking for yield. And that is all we have for this one. So I hope you got a lot out of this. I mean, these are great funds. These are great ETFs. I think they can, anyone that has any type of yield, like yield needs, these could be great for you. So I really hope this video really helped you out. Let me know in the comments if you like any of these, if you're going to invest in one of them. If you do invest in them, tell me in the comments. Would love to hear that. So that's all we have for today's video. Thanks everyone so much for watching. Hit the like button, don't forget that. And of course, click another one of my videos on the end screen that's coming up right now.